Good morning, ladies and gentlemen. Today let's start with something slightly different and examine when and why do crashes happen. Well, what is a crash? A crash is simply a sudden repricing of an asset. When does it happen? Well, it happens when the conventional thinking of the valuation parameters suffers a shift. Currently, we have these parameters for equities pricing. One, and most importantly, inflation is low and long-term interest rates will remain low. Secondly, growth is reasonable, not too hot, not too cold, and fostered by Fed policies. The Fed will hike or taper very slowly, and if anything bad happens, will revert to QE. And finally, earnings are strong and will remain so. Hence, the cash flow generated by earnings can be discounted at the lower interest rate levels, which are shown by the long-term interest rates, to arrive at very high equity valuations. Well, these are the reasons why we are where we are, not the reasons why we should go any higher or any lower. Now, point one is actually key. It all boils down to the level of long-term interest rates. The Fed started QE in order to reduce the level of long-term interest rates and push down the discount factor of equity valuations. If you do that, you raise equity prices. So if you assume that things will remain at, if long-term interest rates will remain at 2% forever, and you have a given cash flow or a higher cash flow than that, then you have to discount the asset price at a higher level than you did earlier. I've told you nothing new. They have told us many times that this is why they entered into QE, to lower the level of long-term interest rates and push up equity valuations. The reverse is also true. If long-term rates revert to mean or higher, the central plank of equity valuations at current levels is removed. Well, when that happens, we have a sudden repricing. 1987 was the most obvious example. Interest rates started rising and rose very rapidly. I remember they went from short-term rates went from about 6.5% to 10%, while 10-year notes went from 7% to almost 9%. And when that happens, you have a repricing. So, almost always when you have a repricing of equities, that is as a consequence of a shift in long-term rates. If we are looking for a repricing in equity prices, we first of all need a repricing in long-term interest rates. This is a weekly yield chart of the 30-year note in the States. And as we can see, we are beginning to break a flag pattern which has been created throughout the year. This is indicative of a very quick move, possibly to 341 in terms of yields, followed possibly by 395 in terms of yields. This kind of move would certainly be consistent with just adding this part of the rally onto the bottom. We could easily see that 395 level in rates. Rates move up much faster than they move down, and we are possibly entering a period whereby rates are going to go much higher, much more quickly than people anticipate. This will probably sow the conditions necessary for a crash in equities, but also will So the possibility of a very quick fall in rates once the Fed comes back in and changes its policies as it sees the result of their actions. The same pattern is evident in a weekly chart of the 10-year note. Here we have the flag, here we have the pole. If you add this distance to the bottom, you get to over 3% in terms of rates. If we were to get over 3% in terms of rates in the 10-year note and somewhere near over that in 30 years, as I've just shown you, we will definitely be in trouble as far as equity valuations are concerned. How this is going to happen, how are US interest rates going to spike quite a bit higher with European rates actually going lower, is a very good question. It is not unprecedented. In fact, it's quite common for bunds to diverge from the price action in 10-year notes. We've had it for many, many years, all the time since 2012. There have been many periods in which US interest rates have gone up 40, 50, 60 basis points, and bund yields have actually remained steady or even fallen. Draghi this week told us something very important. He told us that he is kicking the can down the road, and the bund repriced all of about 5 basis points on the downside. In no way do I think it cannot go back down towards the lows of around 18, 17, 18, but that is only about 20 basis points. All that tells me is that the dollar is likely to take the strain on the upside for the foreseeable future. And here we have a daily chart of the dollar index. It is quite possible, nay probable, that in the weeks ahead, because this is a daily chart and you can see we are through the Bollinger Bands and we have rejected the 95.07 level, we will play around here and then break and test the top of the trend line and the very important level at 96.50, where by that time the 200-day moving average will be. So we are quite likely to be in a 93.63 to 96.50 range for the foreseeable future, with the dollar taking the strain and going up and actually putting additional pressure on US equities. Daily chart of the NQ of the Nasdaq 100, and as we thought, the Nasdaq is now catching up and answering in the move the Dow made last week. It is now in full blowout phase. If you saw what the Amazon did on Friday and also what Google did, you understand the reason for it. We are in a full-blown upward trajectory of all these prices, so we are answering the Dow's move. We've had the move in Dow, we've had the move in ES, now we're having the move in Nasdaq. All that is left is to have the move in Russell 2000. And this is the Russell. It has been consolidating, doing nothing for the best part of a month, and now is ready to go into the fifth wave. First wave, second wave, third wave, fourth wave consolidation, fifth wave blowout, somewhere to around the 1550 area, and in the IWM around 155 or even higher. So we are in the last wave of everything, of hopefully the Russell, but certainly in the SPX, certainly in the Nasdaq 100, and certainly in the Dow. And we are also beginning to be in the last wave of everything in the foreign markets as well. This is the chart of the Nikkei that I showed you last week. It is now very, very close to the uppermost trend line. Comes in just over 22,000, 22,200 or something like that. We are certainly going to touch it this week, and when that happens or goes slightly through it, it'll be a very good risk reward to get some puts on board for a move all the way back down to underneath 20,000. And here we have a weekly chart of the DAX. First wave, second wave, third wave, fourth wave. We are now in 5 of 5 of 5, possibly 13,600, and certainly possibly even higher as a result of the dollar being strong for a while, because the DAX is actually trading very much more as to the value of the dollar rather than doing anything in its own name, as you can see from the next chart. A daily chart of the basically the DAX in dollar terms. As you can see, for the past 3 weeks it's done absolutely nothing. While certainly, yes, the DAX has gone up, but it's only gone up because the dollar's gone down. So the actual level of the equity valuation is absolutely unchanged. We expect that to go higher, way above 33, somewhere around possibly 33.40, and that will give us the DAX certainly around the 13,600 level in the days and weeks ahead. This is a daily chart of FEU, which is the Stocks 50 in dollar terms, and as you can see, that is quite a bit lower over the course of the past couple of weeks, reflecting troubles in Catalonia and so on. That is the reason why we tried to short the Stocks 50 unsuccessfully, but now that tells us that we will have a last wave up in the FEU, possibly getting all the way up here to 36.50 to 36.80 in very short order, as a result of both the dollar and possibly higher equity valuations in Europe as a result of lower bond prices in Europe. A lot of you will ask, well, why should we have higher higher bond yields in the States? Well, I think these charts are beginning to answer that question. These are our commodity charts, and as you can see, they are finally beginning to break higher. This one with oil as the highest component is finally making new high. We think that now it has got a clear run for about a 10% move higher, as do all of these. They will at least retrace above these highs, which gives us a bit of an inflation scare. But most importantly, what it does is raises the prices of inputs and therefore lowers margins for equities, in which case it is more likely than not that the equities will suffer a double whammy. They will have higher input prices, higher wages, and possibly higher discount factors for their cash flow. So we are more likely than not over the course of the next month or so to see a double or triple whammy on US equity valuations. And to conclude, this is the S&P since 2009. I'm always amazed by how beautifully the waves are behaving, and in fact we have the top of the channel around the 2610 area. It would be really poetic if we went and touched it over the next few days and then started our retracement back down towards at least the level of 2130. It would really be poetic. We don't know if that is going to happen. What we do know is that we have the possibility of annulling one of the most important tenets of this whole rally, which has been low interest rates. If that does happen, we are more than ever convinced that we are fast approaching the end of the equity rally at these levels. To test our thesis about higher interest rates, long-term interest rates, we have to look at the behavior of other spreads. This is XLP over XLY. Basically what is happening is XLP is getting absolutely killed, and if basics, food and staples are getting killed, that can only be because the market is anticipating a higher discount factor. People are not going to start eating less, certainly not if they're wealthy, but what is going to happen is that a given level of cash flow generated by a food company is going to be discounted at a lower level because the interest rate that you discounted with has risen, hence the lower equity price of the staples. And this is XLP, so the staples, as a percentage of SPY. You can see that it's absolutely getting killed. That is a sure sign of an anticipation of higher long-term interest rates. This is another interesting chart that shows you that we are at a very, very important inflection point. This is the S&Ps over the commodities. DBC, which is a commodity ETF. We are right on top of the 200-day moving average. A move below it will probably target these levels that we were in April of 2016. And you can all remember what happened to the equity market when that happened. Very interesting junction. Certainly volatility is going to be picking up whichever way this resolves. And I really want to conclude with Gunlach's favorite, which is gold over copper. As you can see, we have definitely broken the trend line. The 50 and the 200 day are very much in a downtrend. We might have tests of the trend line from underneath over the next few days, but certainly I would argue that we are much more likely to see a retest of these levels around 35 than we are to spike higher. If that were to happen, certainly long-term interest rates would be for a very wild ride. What does that all boil down to? Well, it boils down to very large volatility in US and European interest rates. The March 124 straddle on the 10-year is trading at 2.25 points, which is just about one of the lowest levels of volatility that has been seen in many and many a year. We are at 124 in March futures. To say that over the next 5 months March futures will not move outside of a 2.25 point range is to us quite ridiculous, because only last month we were outside of it. So certainly we think that that is the best way to play it, simply because if we are going to get much higher yields, we will easily trade 117 in the 124 straddle. And if that does precipitate some kind of repricing in the equities, we'll probably see 127 on top of that as well. So certainly volatility is the way to play this for both the 10 years, the States, and for the European market. The European market will be much better supported, but if something starts going on in their equities markets, those markets will start moving too. So we would not be sellers of volatility in Europe or in the States. Maybe a spread long volatility in the States, short volatility in Europe is an even better trade. But we probably prefer an outright bet on the 124 straddle in March at 2.25 points. The commodity indices, well, they are finally showing some signs of life. And here we have the levels in equities from last week: 26.10, 22.25, Nikkei buy puts. We'll be buying puts in both and see what happens, because it's just getting quite stupid. As we thought, the NQ is now the most euphoric, 61.50ish. Yes, got it. Now we'll probably get to 62.50 without any problems. But again, these are levels to buy puts. So whenever the NQ is, when we get to 2610 or 22,225, we will be buying puts on everything, apart from the Russell, where we want to see the last spike up to the 1530, 1550 area. We still think that the emerging markets will be a much better buy at some stage. We have our levels. We won't tell you what these levels are yet, because they're quite a long way away, so there's no point in you even looking at them. And the DX, we are looking for this 96.30 to 50 area to trade in the next month or so, which will then sow the seeds of its own destruction, targeting back down towards 90. But there's no point in thinking about that now. 96.30 to 96.50 is where we see this market going in the next 3 or 4 weeks. Well, this butterfly is working. We're doing the maths on it every day. We haven't put it on in any size yet, but it's working because of XLK as opposed to EM. We wanted to get all into sync, and we think we will definitely get an opportunity. Thank you very much indeed, and tweet to you on Monday.